This is all about riders and the power of riders. I'm sure that most of you are familiar with the rider options that you can add to term policies, primarily is what we're talking about here, but they tend to be overlooked a little bit, or maybe an agent just doesn't think of them at the time. But with our help and with the help of Insurio, we're able to set up something where you do a presentation and you always look at these options. So first off is accelerated death benefit. This is a terminal illness rider. One of those is usually included in any of the term policies, and it allows the insured to access part or all of the policy's death benefit while they're still alive. Typically, it requires that they be diagnosed with a terminal illness and have 24 months to live. Sometimes some of them are 12 months to live. And again, it's at no cost. Uh, Pretty basic stuff. It's there, but it is invaluable at such a time. If somebody gets that diagnosis, they don't have to wait. They're going to be having all kinds of medical bills and things that need to be addressed immediately, and they can have access to their death benefit to take care of that. Chronic illness rider. Having a chronic illness means that you are unable to perform 2 of the 6 ADLs, the activities of daily living: bathing, toileting, dressing, eating, transferring continence. That's pretty standard stuff across the board with all the carriers. And the great thing about this is it can be used again if somebody is in need of money to take care of obviously some health issues and the bills that pile up when you are in that situation. And you don't have to be admitted to a facility. You don't have to get reimbursed after incurring the bills yourself and taking care of them and then submitting them to be reimbursed to the carrier and getting it approved and all that. Once you're approved on this, based on that diagnosis, you have access to money and you can use it for whatever you need, even if it's groceries or whatever. So CIR, this chronic illness rider, is an indemnity rider, which means just that. It pays out a predetermined monthly benefit rather than reimbursing you for those qualified expenses, which is a pain and a delay and an expense. Critical illness rider. The critical illness rider is typically activated if you're diagnosed with specific qualifying conditions, and as opposed to those loss of the ADLs that we previously talked about. And these conditions will often include, they're not all the same against all carriers and products, so take a look at it, but typically it'll be cancer, kidney failure, heart attack, stroke, paralysis, and the such things that qualify as a critical illness, and again, you can have access to your death benefit at that time. Accidental death benefit. This is just like it sounds. If one were to die of an accident, it adds to the death benefit on their policy. So the accidental death benefit is sometimes referred to as a double indemnity clause because it can even double the death benefit. Usually there's about a $250,000 limit on these things, but it can increase the death benefit to that amount that your beneficiaries get if you die from an accident. Common exclusions to that would include drugs and alcohol use involved in the death, criminal activity, or suicide. Those things after a 2-year contestability would typically still pay out the death benefit, the base benefit, but not the rider. Waiver of premium rider. This one's really important, and I've got agents that always include this with any of their working age clients. Anybody that is working, they put this on there and present it as such right away. So they can consider it. This rider will pay or waive your life insurance premiums if you become totally disabled and can't work. It'll usually include a waiting period of 6 months, but once that waiting period is satisfied and your claim is approved, you'll be reimbursed retroactively to the beginning of the disability. For their working clients, as I said, many agents will quote policies with the WOP option and strongly encourage that they take it. If for some reason they say, no, I don't know, and I don't want, okay, they can present both with and without, and they can see that it doesn't cost much more. And if you're in that situation, I could tell you stories, believe me, real life stories of people that have been in that situation. One of the first things that they consider dropping is a life insurance policy. So that can just add to their problems. So this will alleviate all that. The return of premium rider. There's not that many out there anymore on the term policies, but there's a few good ones. Cincinnati Life, for instance, has a really good one. And it, again, is just like what it sounds. It refunds some or all of your premium payments if you outlive the term policy. And yeah, it costs a bit. Relatively speaking, that's not the least expensive of the riders. However, some of your proposed insurers, some of your clients will insist on getting quotes for this option. They don't want to walk away at the end of a 30-year term or whatever without having anything to show for it. And they at least show them the option and say, here's what it would cost at the end of the 20-year term or the 30-year term or whatever it turns out to be. You can illustrate, here's how much money they would give you back. And hey, if they're convinced that they're going to live and be healthy that whole time, you can show them exactly what they will walk away with in dollars and cents. And they effectively got free insurance for the 20 or 30 years. So not a bad idea. A child rider. And you can add the child rider to cover your children, and it's just that your children. It's not a child rider for each child. You add the rider, it covers all children, and that saves you from buying separate policies for all the kids. Face amounts are usually from 5,000 to 25,000. 25,000 I think is the max that you can get. I think you can actually get down to about 1,000 on some carriers, but 5,000 to 25,000 is typical. And this rider will usually cover all of your biological stepchildren, oh, stepchildren, and adopted children and future kids. So if you have one kid and then 2 years later you have another, okay, great. You just add them on, they're automatically added to the coverage. And this will stay in force usually for most of the riders, for most carriers, until your youngest child reaches the age of 25 or the insured parent reaches the age of 65. And then it also allows for conversion to permanent coverage once the child reaches that age of maturity, age 25, they can convert it to something permanent and take over at that point. Hopefully 25, 26, they're actually out of the house, maybe they're going to college and they could use such a thing, maybe starting their own families. And that's a good thing. They won't have to qualify medically for that at that time. And a charitable giving benefit rider. I would guess that a lot of agents aren't aware of this one, and it's out there. I think it's probably more common on some of the permanent products, but you can find them. It's worth looking at if somebody wants to give to their church or some other charitable organization. This will add 1% to the death benefit. It doesn't take away from your designated beneficiaries. It just provides at no additional cost 1% of the death benefit to a qualified charity of your choice upon your death. Really nice thing. Tends to be something that maybe more senior applicants do, and they'll want to look into that, or if they don't know about it, point it out to them. It's an easy thing and it doesn't cost a thing. Term writers. Term writers is kind of a convenient and fancy way of saying uh, layering or laddering a policy. So it's a common strategy, and it's a good one. I'm a proponent of that, where you can layer maybe a 30, a 20, a 10-year term as you go through life. They drop off as it comes to the end of these terms, and it meets your needs, and it meets life events when you retire, when your mortgage is paid off, when the kids leave the house, things like that. If a policy or carrier offers the term riders, it's a convenient way to stack or ladder or layer the term coverage. The term riders may be stacked on top of the base policy, and at the end of each term they automatically drop off. And the benefit to that is you don't have to pay additional fees and things for multiple policies. Same effect, just easier way of going about it. Automatic, kind of a no-brainer. It takes care of itself as you go through life. Conversion. It's not really a rider because almost all term insurance policies are guaranteed convertible without proof of insurability at the end of their term. However, as it says here, not all conversions are created equal. So you want to pay attention to such things. Some carriers allow conversion up to age 70, some only to 65. That can become important at the age of 65 or 70, of course. Some may even require the purchase of a separate rider to extend their conversion period up to age 65. That's fairly rare, but if it's there, you want to be aware of it because that policy might not be convertible the entire term or to the end of the term or to age 65. It might only be like 15 years, and you have to purchase the extension rider to bring it to the normal 65 years where most of them already have that. And some carriers limit the options to only a single permanent product that you're allowed to convert to, while others allow conversions to any of their permanent products. Then again, another aspect to it is some of them will allow anything you want in the first 5 years or so, and then it'll narrow your options thereafter, maybe only a couple options after that, and maybe at a certain point they only offer one. But it's something that you want to keep on top of as you're looking at your book of business, see where people are in their conversion eligibility and what their options are so you can make them aware of it in case they want to convert. They might want to have a whole life option and not be limited to like a GUL like Banner does from day one, for instance. Just an example. And guaranteed renewability. Again, not so much a rider. Guaranteed renewability allows you to continue your policy at the end of the term without proving insurability. And things to remember about that, again, it's almost on all term policies. Once in a while, you might find one that doesn't have it, but almost all of them have it. And once the policy is renewed, it becomes an annual renewable term. That's important because that means although they're covered and they don't have to prove insurability to be covered, the rates will go up every year. And it's not uncommon to find a client be covered and go beyond, say, their 20-year term, their year 21, and it's an automatic payment EFT coming out of their bank account, and they keep it going, not even notice. And then the next year it goes up and they still might notice. I can pretty much guarantee you they're going to notice the third year because it starts jumping dramatically at a certain point. And so watch your book. Again, watch your book of business for policies approaching the end of term, or if they're already in that ART stage, reach out to your client because that's a great opportunity for service and sales and just retouching base with your clients and maybe making them aware that, hey, did you notice what they're taking out of your accounts lately, and get them some new coverage or maybe get some referrals.